Oh, that's him. Yo, what's Burndy's channel? Burndy? Burndy Forex Trader.
Hey everyone.
Most popular video. Oh, that's the number one video. Here's number one at FTMO. You can't fake that, chat.
Hey.
You cannot fake that. How to detect trading BS.
Do you think it's possible to make a consistent...
Okay, let's watch this. I'll be back in like 1 minute, chat. I'm excited for this video. Hold on. Yeah, I want to watch this video. You've been lied to. How to detect trading BS. Okay, show us the college plays, bro. Show us who the college playing.
80% winning trades? Wrong. I'm here to call out so-called YouTube gurus who claim they can do it and tell you why it's impossible. Hello, I'm Bernd. I have over 10 years of experience as a full-time professional trader, manage funds in the 7-figure range, and I'm the CEO of a licensed investment consultancy based in Dubai. Additionally, you can see my verified results on FTMO in my other videos. I've seen too many people fall for the trap of traders falsely claiming 80% win rate. These self-proclaimed gurus will tell you all sorts of stories about how they master the market and make huge profits. But it's all lies. Well, today, I'm putting an end to it once and for all because I'm calling out all those so-called 80% winning traders. And I'm going to break down what KPIs really work in the long term. Excited? Me too. Let's start. Let me quote George Soros, an American investor with a net worth of 6.7 billion US dollars. It is not about how often you're right or wrong, but it's all about how much money you make when you're right and how much you lose when you're wrong. Let me get something straight right from the get-go. Your win-loss ratio or winning percentage is of zero significance on its own. It does not have a finite role to play in deciding how efficient a trading system is or how good a trader is. It is still quite possible to lose money with an 80% win rate if you fail to manage your losses well. However, you can always be profitable with just a 30% win rate if you have mastered how to let your profits run and cut your losses short. George Soros' concept boils down to one thing: your risk to reward ratio. Let's look at two different scenarios. Before we get started with some number crunching, let's quickly re-emphasize on the core concept that allows us to audit our decision making and performance. KPIs are only the result of the set we place: stop, entry, target. Without a set, we cannot measure our performance. Alright, let's assume in scenario 1, you're planning to buy euro-dollar at 1.0823, stop loss at 1.0778 and target at 1.1048. Now price comes into our buying zone and eventually moves out of the zone into the target. The question is not how much profit you made on this trade. The most important question is how much profit you made in relation to your risk. In other words, what is your risk to reward ratio of this trade? If prices were to fall, we set a stop loss to manage our risk. So the risk is measured from the entry to the stop loss. Let's view this as 1 or X, meaning it is a variable. You determine the dollar amount risk yourself. You could risk $10, $100, $1,000, or you could risk $1 million with this zone parameters. It is a way of using calculated risk. You know exactly how much you're willing to lose, and this can be predefined in the set you place. For the sake of this example, let's say here in this case, you risk $1,000. Let's have a look if this reward was good enough for us to take the trade. The reward is measured from the entry to the target. What was the profit in relation to the risk? For every dollar you risk, you make $5 of pure profit. What would a risk to reward ratio of 1 to 5 look like for you as a professional trader taking a predefined risk of $1,000? $5,000. Solid. Let's look at the second scenario. Here I changed only one parameter, the entry. What I want to show you is how changes your set parameters can have a big effect on the outcome of the trade in terms of risk to reward. You missed the entry at 1.0823 because you waited for price to rally. Now you see the price rallies and you start to chase price and you enter at 1.0913. Keep in mind that the target and stop loss remain unchanged. They are placed as per your rules. What happens to your overall risk to reward ratio? It changes drastically, but not in a good way, because now for every dollar you risk, you only make $1 of reward. Consequently, your risk to reward ratio in scenario 2 is 1-to-1. Or speaking in actual dollar amount, let's take the same risk you decided to take in scenario 1, $1,000 per trade. Instead of making $5,000, you only make $1,000. Now you may argue, profit is profit, I'm happy with $1,000, and that's a good point. Let's evaluate the two scenarios in more detail. Now here to the left, I have trader A, who takes only trades that have a profit potential with a risk to reward ratio that is bigger or equal than 1-to-5. And according to his business plan, he takes $1,000 risk per trade. Trader A takes 10 trades. First trade he loses. How much does he lose? $1,000. His predefined calculated risk, not more, not less. That's his 1. Second trade, he lost again. Third trade, he lost. Oof, 3 trades down, $3,000 down. Let's look at the fourth trade. The fourth trade is a winner. Due to his strict rules of only taking trades with a risk to reward potential of at least 1-to-5, he made $5,000 of profit. Trade 5, he lost. Trade 6, he lost. But trade 7, he makes another profit, and this time he generates a 1-to-7 risk to reward ratio. He banks in $7,000 of profit. Next trade he lost, the 9th trade he also lost, and the 10th trade he achieved a 1-to-6, banking in another $6,000 of profit. Let's assume these were his monthly results. Just like any other business owner, also trader A evaluates the performance of his business based on a simple P&L calculation at the end of each month. So let us do that quickly. His profit, $18,000, and his losses are $7,000. Overall, a solid profitable P&L of $11,000. In other words, trader A made $11,000 in this month. And looking at his winning percentage or win-loss ratio, he had 7 winners and 7 losers. So overall, a 30-70 win-loss ratio. Now let's look at the right and examine what trader B does. Trader B has an average risk to reward of 1-to-1 on his trades. And trader B takes the same dollar risk amount, $1,000 risk.
How about us?
Trader B also takes 10 trades, and as you can see, he has a very high winning percentage, and in fact it's 80% winners and only 20% losers. And when he loses, he also loses only $1,000 per trade. But when he wins, since his average risk to reward ratio is 1-to-1, only makes $1,000 per trade. So if trader B is looking at his monthly results, he generated $8,000 in profit. On the other side, he had $2,000 in losses. Consequently, overall on his P&L, he made $6,000 in profit. Let's compare the two. Who has the better performance? Trader A made $11,000 and trader B made $6,000. So it's clearly trader A has the much better performance, although he has the much worse win-loss ratio. What we can derive from this example is that risk to reward ratio.
I'm trader A, right? Like the way we trade? For sure, trader A. The rest of the word is crazy.
KPI for all professional traders and investors, and win-loss ratio has no or only little impact on a trader's performance.
We're definitely not
Now
trader
you
B.
could still argue, well, I'm happy if I can achieve trader B's results because yes, he is still profitable. But let's now examine if the win-loss ratio that trader B achieved, 80-20, is a realistic number you can achieve in the trading arena. So this is a screenshot from Goldman Sachs Annual Report 2022. You can check it out yourself. Just Google Goldman Sachs Annual Report and you'll find it. This is not classified information. This is amazing. Let me just zoom in a little bit for you to see the stats. They paint the picture pretty well. Let me explain. See right here where it says daily net revenues. These are the actual daily trading net revenues from their own trading desk. Trading with the bank's money. They actively trade on a daily basis. This right here is showing you how many profitable days Goldman Sachs had compared to losing days. 9 losing days, so nobody's perfect, but close to perfect. But look at their win to loss. I'm looking at their annual report every single year since 2013, and they're always consistent in their results, having a winning percentage of around 80 to 85%. This is without doubt the most powerful and most influential bank.
Wait, so he has a high win rate. So what was he saying about not good to have a high win rate?
Having a winning percentage of around 80.
He has 86% win rate, no?
To 85%. This is without doubt the most powerful and most influential bank in the entire world. Half of former President Trump's team consisted of Goldman Sachs employees. Also, Draghi, former European Central Bank president, was a Goldman Sachs employee. So, if they're winning around 80% of their trades, how can we as retail traders expect to have similar stats than them? It's just impossible. And then you have some 20-year-old YouTube trader gurus who claim to have similar stats than Goldman Sachs. Give me a break. It is possible to have winning streaks throughout the year with impressive stats. However,
What the fuck, bro?
it is impossible to have similar stats like Goldman Sachs and other powerful banks and institutions that essentially control the market through the entire year. In summary, anyone who says they have an 80% win rate is likely a scammer. The performance example here on this
Yo, I swear I'm not a scammer, chat, bro. Where? Oh, no, why you do us like that, bro? How many views have you got? Yo, why you do us like that, man?